Hello friends, good morning to all of you, and today in this video we are going to discuss about the next chapter from the module D of the BFM, which is related to the interest rate risk management. So do confirm the audio video quality at the earliest so that we can proceed. So आज का ये chapter जो है that is quite important. So the audio video quality is working all fine. So let's start the session. And the complete course for the CAIIB BFM is now available, where you'll be getting the full course videos, the chapter wise previous year questions, mock test, mega test will be there, and the PDF notes are available, which are downloadable as well as printable. So the audio video quality is working fine. Let's start the session. So the chapter is related to the interest rate risk management practices, and this is the fifth chapter related to the bank financial management. The last chapter, it was related to liquidity risk management. And let me tell you that this chapter is quite important from the exam point of view. So do confirm the audio video quality. Some of you are facing the issues related to the audio video quality. Do confirm the audio video quality so that we can proceed. Right. So what is actually the interest rate risk is? Like, if there is adverse movement of the interest rate, that's going to impact your portfolio. That's the interest rate risk. So if the risk is there, adverse movement of the interest rate is there, which is going to impact the net interest income, or let's say that is going to impact the net interest margin, then it is said to be the interest rate risk. And let's say then it is going to impact the economic value of the assets or liabilities. It will be impacting the economic value of the assets and liabilities due to the adverse rate movement. Now, what is NII? The net interest income, as I've already told you, it's like interest that we earn minus interest that we are paying, or interest expended, we can say, or the interest paid, right? And what about the NIM? What is the formula related to NIM? Any idea? The NIM formula is net interest income. Let me write over here. NIM is equal to net interest income divided by the average earning assets, or simply we can say the earning assets. This is the formula related to the NIM. Okay. So when there be impact related to it, it's going to impact your earnings. It's going to impact the capital base, and definitely it's going to impact our net interest income and net interest margin. So the first impact would be related to the change in interest rate, and it's going to impact our net interest income and profitability. So that's the first thing, net interest income, or it is going to impact the profitability, right? We say such risk to be the interest rate risk. That's the first impact. And the second impact, it could be related to the economic value. It's going to impact the first case was net interest income and the profitability. The second, it is going to impact the economic value. The economic value it's going to impact, right? So it will lead to change in the valuation of the assets, liabilities, and even the OBS items. So whatsoever the assets were there, liabilities were there, off balance sheet instruments were there, their economic value is reduced. And what are the major reasons? Like, if we look at interest rate risk, we know that what it is. It's going to reduce your income, profitability, economic value. That's quite normal to understand. But what is the main cause? What are the key causes? Let's have a look at it. The first one, it's related to the maturity mismatches. Like if you're holding the long-term assets, if you're holding the long-term assets, or let's say asset or liability maturity or repricing is not matching. You're having an asset, let's say you're having a loan, you're having a liability, that is a deposit, right? The asset is to be repriced after 1 year, let's assume, right? Or let's say asset is repricing after 3 years, after 3 months, it is to be repriced. But the liability, that's a deposit, is going to reprice after 1 year. Now, it may be the case that after 3 months, the interest rate decreased and ultimately your net interest income will be reduced, right? So, this could be due to the maturity mismatches. This could be due to the maturity mismatches. And this is a common example, like the long-term loans are when funded by the short-term deposits. You were having the loan amount for 3 years and it was funded by a deposit of 1 year. Definitely the the interest rate risk is there if the repricing is not matching. So what will be the impact? Like if the interest rate increases, the impact will be what? That if the interest rate increases, the asset value is going to fall related to more than liabilities. The asset value falls more than the liabilities if the interest rate increases on the liabilities, right? And it will lead to what? It will lead to the erosion risk. The risk of insolvency will be there. So let's have a look at the types of the interest rate risk. Let's have a look at the types of the interest rate risk. The first one, it's the gap risk or the mismatch risk. Like when we are having the risk sensitive assets and the risk sensitive liabilities, those particular assets which are risk sensitive, the gap between them, like RSA minus RSL, that is said to be the gap. So the gap is equal to what? Gap is equal to RSA minus RSL. And when the amount of RSA, the risk sensitive assets, are greater than the risk sensitive liabilities, we say such gap to be the positive gap. We say such gap to be the positive gap. And on the other side, if we say the risk sensitive assets are lower than that of the risk sensitive liabilities, we say such gap to be the negative gap. Getting it? So in case of the positive gap, first of all, in case of positive gap, if the rate increases, let's say interest rate we are talking about, if the rate increases, the profit will increase or decrease because you are having more risk sensitive assets. Let's say you are having the risk sensitive assets to be 1 lakh and the liabilities of 50,000. In that case, if the rate increases, that will be more beneficial to you in case of the assets and more earnings will be there. So definitely you will be beneficial. So if the interest rate is increasing, it will lead to increase in profit in case we are having the positive gap. On the other side, if we are having the interest rate decreased, now you are having rate sensitive assets more. So it will be lowering your profit. So your profit is overall lowered. Getting this point, this is quite important and the basis of the complete chapter. You should be knowing these points thoroughly, paying attention toward it. So first case, I told you about the case when the risk sensitive assets are greater than the risk sensitive liabilities. We are talking about the positive gap, right? Second thing I told you, what if the interest rate increases? If the interest rate increases, now we are having the more risk sensitive assets. And the case where we are having the more risk sensitive assets, the profit will be more. Why? Because we can be earning more on the risk sensitive assets. So profit will be more there. Okay, so that's the case. The second scenario, it's related to when the interest rate decreases. When the interest rate is decreasing, it is decreasing more on the risk sensitive assets. So our overall profitability will be lowered, right? So that's the scenario. And similarly, if we consider it related to the negative gap, related to the negative gap, when the risk sensitive assets are lower than the risk sensitive liabilities, in that case, if the rate increases, if the rate increases, the profit will be higher or lower? Do answer. The profit will be increasing or decreasing? The profit will be increasing or decreasing? I'm talking about the negative gap. If we are having the negative gap, risk sensitive assets are lesser than that of the risk sensitive liabilities, and we are taking the case that the rate increases. Now the rate will be much more increasing on the liabilities because we are having more risk sensitive liabilities, means the paying part will be increasing and the receiving part will be not increasing that much. It will not be increasing that much, so overall profitability will be lowered. So we can say the profit will be decreasing in this case. And the second scenario, like where the rate decreases, now you are having more liabilities, risk sensitive liabilities. So rate will be decreasing much more on the liabilities part, will be decreasing on the assets, but not that much. So our profit will be increasing. So our profit will be increasing for this case. Getting it? That is how the treasuries are to maintain, the banks are to maintain the composition of the assets and liabilities in such a manner that whatsoever the scenario is, that we are to make the much more profit out of it. Right? So this is the gap risk or the mismatch risk. This is specifically related to the gap risk or the mismatch risk. Getting it? Clear with it so far? Right? Further after that, it's about the basis risk. It's about the basis risk. Basis risk is like the assets are based upon some benchmark. The asset is based upon some benchmark. The liabilities are based upon some benchmark. Let's say the assets are based upon the benchmark B1 and the liabilities are based upon the benchmark B2, right? And the repricing is there. And the repricing is there. But the repricing was there. Was there related to what? The repricing was there in opposite direction. Like the lending rate changes faster than the deposit rate. Now both are based upon some benchmark. Asset is based upon the benchmark B1, liability is based upon the benchmark B2, and further both are changing. Lending rate change, both are changing, but not equally. So either it can be increasing the value or it can be decreasing the value. Both can be the scenarios. And the risk is about what? That when both are changing, but overall income is reduced, then the risk which can be imposed is the basis risk. In that scenario, the risk which can be imposed is the basis risk, right? Further, it's related to the net interest position risk. Net interest position risk. Now, net interest position risk means what? Like I already told you that we are having the risk sensitive assets in the portfolio, we are having the risk sensitive liabilities in the portfolio. Now, if they are not matching, and definitely that is not true. Like it's not always true that we can match the risk sensitive assets composition with the risk sensitive liabilities. Ideally, we want to do that, but it is not possible and practical, right? So, net interest position would be related to what? That your net position will be exposing you to the additional interest rate risk. So if you're having a bank is having the more risk sensitive assets as compared to that of the risk sensitive liabilities, right? So you can be earning much more interest on your assets as compared to that of the liabilities. Now, if the interest rate increases, you will be beneficial. But what if the rate of interest decrease, like we discussed in the case of the gap risk? So this is somewhat related to the RSAs and RSL. Gap risk was concerned about both the parts, the negative gap as well as the positive gap, right? But here we are talking about what? Here we are talking about that we are having the gap. Here we are talking about the part that we are having a gap, that the risk sensitive assets are not equal to the risk sensitive liabilities, that we know. But it could be the case that if the interest rate increases, like if the interest rate increases and RSA is more than the RSL, then we'll be having the profit, then the profit will increase. On the other hand, if in the same scenario, when your RSA is, we are considering greater than the RSL, this is a case we are considering, right? So in case the interest rate decreases, definitely you'll be paying much more. You will not be having that much benefit. The profit overall will be reduced. The profit overall will be reduced, right? So this is how it works. So that is a net interest position risk. Net interest position risk. Further, the another one, it's related to the embedded option risk. The embedded option risk. Now, if there is, let's say, prepayment, there is prepayment of the loan, right? Or let's say there is early withdrawal of the deposit. Those are the options which are available with the borrower and the depositor. So from the borrower, they can be prepaying and the depositor can be early withdrawing the deposit. So in that scenario, also the risk is imposed. Your overall earning will be reduced. Your overall net interest income will be reduced. So the borrower prepays the loan interest, definitely the overall interest is reduced. And the bank is forced to, let's say, reinvest at the low rate in that scenario. So what will be happening? How the risk will be there? Like, let's say you have sanctioned a loan of 10 lakh rupees. You sanctioned a loan of 10 lakh rupees and it was to be repaid in 20 years, right? But the borrower repaid in just 10 years. Now, after 10 years, you're getting all the amount and you are forced to reinvest that amount, that you are forced, that you have to reinvest that particular amount somewhere. So that is a embedded option risk. That is a embedded option risk. Then it is related to the yield curve risk. Like in the case of the treasury bills, we are having what? We are having the treasury bills of the different maturities for 91 days, for 182 days, for 364 days, right? These are the different maturities that we are having. Now, a risk is there due to change in slope or shape of the yield curve. Because for the different maturity, the different yield may be there, even though the instrument is all same. So the parallel shift can be there. There could be steepening, there could be flattening. The point related to it is right. So there is parallel shift. There is parallel shift even related to the one particular instrument. So that's a yield curve risk which is present. That is present. Now, as the economy moves through the business cycle, the yield curves can be changing frequently, right? So that's about the yield curve risk. Further after that, it's related to price risk. Price risk is like we should be knowing one thing, that the bond prices are inversely proportional to the interest rate. So if the interest rate increases, the bond prices will go down. And if the interest rate decreases, the bond prices will go up. So there is an inverse relationship related to it. There is inverse relationship related to it. So price risk is going to occur when the assets are sold before the maturity dates. So it's important in the trading book. So price risk is important where? The price risk is important in the trading book, because when we are going to sell the assets before the maturity date, then it will be like materializing, right? Further, there is a reinvestment risk. Reinvestment risk is what? Let's say you have a loan and the person is repaying the loan to you. The borrower is repaying the loan. Now there is a liability upon you that you are to reinvest these particular amounts. You are to reinvest these particular amounts, right? So that is a reinvestment risk that is imposed upon you. Here it is a reinvestment risk which is imposed upon you, right? So previously, if we have given the loan at 9%, then there is an obligation. It's kind of risk that if you're not able to reinvest it at the 9% minimally, so if you able to reinvest it at 8.50, you are facing this reinvestment risk. You're facing this reinvestment risk, right? Further, it's related to the bond pricing formula. Bond pricing formula. I already told you that bond price is inversely proportional to the interest rate. On the one side, if we are having the bond price, and further it is inversely proportional to the interest rate. And moreover, bond pricing formula basically assumes what? The bond pricing formula. If you remember, the bond pricing formula is actually what? Like if we are to calculate the present value of the bond, it is like the present value of the cash inflows. So whatsoever the cash inflows are there, we have to calculate the present value of the same, whether the coupon we are talking about or the face value we are talking about, we have to calculate the present value of the same. And in that particular case, we are having one assumption that whatsoever the coupon that we are going to receive, those are basically reinvested at the YTM. Those are reinvested at the YTM. This is the assumption. And this is quite important assumption in this case. This is quite important assumption for this scenario. Now, if the interest rate increases over the life of the bond, if the interest rate increases over the life of the bond, then the coupon will be reinvested at the higher amount. So overall income will be increased. But on the other hand, there is always a risk that it may be the case that we are not able to reinvest the coupons at the YTM rate. It may be the case that we are to invest the coupons at a rate lower than the YTM. Then what risk is imposed? The reinvestment risk is imposed. The reinvestment risk is imposed in that case. Okay, clear with it? So what strategy should the management be following? So management tries to match the duration of the assets and liabilities, not just the maturity, but the management tries so as to match the duration of the assets and the liabilities. So whatsoever the particular assets or liabilities you are having, the management tries to match the duration rather than just matching the particularly just matching the particular uh, things. Otherwise just maturity won't be helping. The management tries so as to match the duration. Further, it's related to effects on interest rate risk. What are the effects of the interest rate risk as there? What are the effects of interest rate risk are there? So first, it's about the earning perspective. Like this is a very traditional approach. Like I had told you already, earning perspective, like it is going to impact your net interest income. It is going to impact your net interest margin. So when we are talking about the earning perspective, it's about the short-term profitability we are talking about. So when we are talking about both NII or NIM, we are talking about the short-term profitability. The short-term profitability, right? So your capital adequacy market, and further if the earnings are reduced, It's going to affect the capital adequacy. It's going to impact the market confidence, right? So the focus of analysis is basically changing in the interest rate. And if the interest rate changes, it's going to impact your net interest income and the net interest margin. And net interest margin, it will be impacted. And further, in many of the cases, the non-interest income is there, like fee-based income is there, and that can also be very much sensitive in relationship with the market interest rates. Like not only the interest income is impacted, but also it may be the case that the non-interest income may be impacted. It may also be the case that your non-interest income is impacted, right? Clear with it so far? And other than that, it's related to the economic value perspective. The economic value perspective. And why the economic value perspective will be there? Like economic value perspective, first of all, analyzes the effect of interest rate, like the overall value of your assets, liabilities, your off balance sheet positions, that is going to be altered. And basically, we do what? We do calculate the present value of these assets, liabilities, and the off balance sheet positions. And that is going to change anyway, right? So when we are going to discount at the current market interest rate, the present value of the expected net cash flows, definitely there is going to be an impact, right? Clear with it? And when we talk about the economic value of the particular bank, we are talking about the present value of the assets, the present value of the liabilities, the present value of the expected off balance sheet positions. Assets means the loans, investments, advances, right? When we're talking about the asset, when we are talking about the assets, it means we are talking about the loans, advances, etc., etc. When we're talking about the liabilities, it means we're talking about the deposits. And when we're talking about the OBS positions, off balance sheet positions, means we are talking about the guarantees, derivatives, commitments, right? All those parts. So those all are impacted. The economic value of all are impacted due to the interest rate movement. And this economic value framework is much more comprehensive. This is much more comprehensive. Why comprehensive? Because here we are focusing mainly on the near term earning. In the case of the earning perspective, like the earning perspective is based on the short term logics. But when we're talking about the economic value perspective, we are concerned about the long term value. We are concerned about the long term here in case of the economic value perspective. And the economic value perspective is much more comprehensive because it is based on the present value of the future cash flows, and it is going to capture the long term impact of the rate changes. It is going to capture the long term impact of the rate changes, and it is useful for overall balance sheet risk analysis, right? Further, it's related to the embedded losses. The next one, it's about the embedded losses. And when the embedded losses do arise, when the instruments which are not marked to market, they already do contain the losses due to the past movement in the interest rate. Now, the instruments which are not marked to market instrument means what? That whatsoever the market price is there, that will be impacted. That will be impacted. That is MTM. That is marked to market. That is marked to market basis, right? And further, the instruments which are not marked to market, but they already do contain the losses due to the past movement of the interest rate, that is the main reason related to the embedded losses. Like it could be a hidden loss, it could be the built-in loss, right? So if the market rates move adversely, there will be embedded loss related to it. Just take an example. Just look at the example. Now, bank sanctioned a long term, long term fixed rate loan. Market sanctioned what? A long term fixed rate loan was sanctioned when the interest rates were low. Let's say the interest rates were very low and the fixed rate loan was sanctioned at 8% for the long term basis. And later on, the bank is going to refinance this particular loan carrying a higher interest rate. Let's say your overall interest rate is 9% at a later stage. No, this particular asset, this particular asset is carrying an embedded loss. Why? Because it was due to your commitment that you made in the previous time. At some previous time, you made some commitment about it, but it's going to have the impact upon you. Here also, the final impact would be related to the bank's resources for the remaining life, right? So this is how it's going to impact. Getting it? Clear with it so far? The next one, it's about the measurement of the interest rate risk. The measurements of the interest rate risk. So if we are to manage the interest rate risk, first of all, we are to identify the risk. We are to identify the risk. Then we are to quantify, right? And we are to select the appropriate techniques. Techniques are to be selected. And without measuring, without quantifying, we cannot be assessing the exposure level. We cannot be designing or deciding the hedging strategies. We cannot be able to maintain the profitability or the capital adequacy. So the first thing that we need to do, like the measurement that we need to do after the identification, the first thing, the first method is about the repricing schedules. We have to look into the repricing analysis. And the repricing schedule is going to distribute the risk sensitive assets and the risk sensitive liabilities and the off balance sheet positions into the different time bands. So we will be considering the different time bands. Let's say for 0 to 1 month, 1 to 3 months, 6 to 12 months, 1 to 3 years, above 5 years, etc. etc. So these will be the different time bands. And for those time bands, let's say we are considering the time band for 1 to 3 months. For this time band, we'll be looking into the risk sensitive assets and the risk sensitive liabilities. Let's say the RSA are 15 and the RSL is 12. RSA is 15 and RSL is 10, right? So all the particular instruments are to be considered. Even if it's a fixed rate instrument or it's a floating rate instruments, those are to be considered. All are to be considered. And if the instrument is a fixed rate instrument, right? For that case, the remaining maturity is to be considered. Remaining maturity is to be considered. And for the floating rate instrument, the next repricing date is to be considered. For the floating rate, the next repricing date. The next repricing date that is to be considered. Right? Clear with it? And after that, like those assets and liabilities would be put into different intervals. Like I just told you, for 1 to 3 months, 3 to 6 months, 6 to 12 months, etc. We'll be looking into the risk sensitive assets and the risk sensitive liabilities. Now, if the RSA is greater than the RSL, RSA is greater than the RSL, that will be what? That will be a positive gap or the negative gap. That is a positive gap. And this analysis where we do find out like it's a positive gap or negative gap, that is the gap analysis. That is a gap analysis, and this is a earning perspective tool. This is the earning perspective tool, right? So gap analysis is going to measure the earning sensitivity to the interest rate changes. Earning perspective to the interest rate changes that we are going to find out. We have already learned about it that under the positive gap, if the rate decreases, the profitability will decrease. If the rate increases, the profitability will increase. And the opposite the case is there in case of the negative gap. We have already learned that particular part. We have already learned that particular part, right? And moreover, we have now know the positive gap, we know about the negative gap, that we already know. These things we already know. So gap identifies the short term earning exposure, because it's earning perspective na gap analysis is. So it is basically short term earning exposure basis. It identifies the short term earning exposures. And the gap analysis is used for what? It is used for the asset liability management decisions. So it identifies the short term earning exposure, right? And it is used for the ALM decision purposes. And what are the shortcomings of the gap analysis? First limitation is related to what? That uniform repricing assumption is there. We do take an assumption. We do take an assumption in this particular case. In the case of the gap analysis, we do take an assumption. What assumption is taken? That uniform repricing assumption is taken. That's the first shortcoming. That we do assume that all the assets and liabilities in a particular band, they are to reprice simultaneously. Let's say when we are considering even 1 to 3 months of the band, we are considering that all the particular assets liabilities are going to reprice on the same, they are going to reprice simultaneously, which is not the case. That's the first assumption. That's the first shortcoming, limitation. The second one, it's related to, we do ignore the basis risk. We do ignore the basis risk. Like the different interest rates may not move uniformly. We are not considering that particular part, right? Different interest rates may move differently. We do not consider that part. We do ignore the basis risk. We do ignore the embedded option, like the third part. We do not consider the embedded options. Like there could be prepayment, there could be early withdrawal. Those are not considered. And there is no time flexibility. So basis risk is basically ignored. The embedded risk, that is ignored. And there is no timing flexibility. There is no timing flexibility. Like cash flow timing changes are not captured at all. And we do ignore the non-interest income. The non-interest revenue expenses, those are not captured into this when we're talking about the gap analysis. Fee income sensitivity is not considered in this scenario. Fee income sensitivity is not considered, right? So these are the shortcomings of the gap analysis. We are just concerned about what? For the short term earning perspective and used for the ALM purposes and interest positioning. But we do consider that uniform repricing will be there. Simultaneously, repricing will be there. We do ignore the basis risk. We do ignore the embedded option risk. And for the We do not consider the time flexibility, and we do ignore the non-interest income. We do ignore the fee-based income. For that particular part is not considered at all in the case of the gap analysis. These are the shortcomings of the gap analysis. The third one, it's about the duration. Now, duration is basically what? Duration is the economic perspective tool, like economic value perspective tool. Like in the case of the gap analysis, we were looking at the earning perspective, right? But here in the case of the duration, we are looking at the economic value perspective. So duration measures what? Duration measures the sensitivity. Duration measures the sensitivity of the instrument to the interest rate change. Like what interest rate will change and how sensitive our instrument is toward that. And it is based upon timing and the size of cash flow. So the duration is basically based on the timing. It is based upon the size of the cash flow, right? And moreover, it measures what? It measures the sensitivity of the instrument. We look into the sensitivity of the instrument to the interest rate, like what amount of interest rate will changes and further it's going to impact this particular instrument. So higher duration means higher the sensitivity. Higher duration basically means higher the sensitivity, and it will be having the higher or larger impact on the economic value, right? And moreover, long duration means what? If you are having longer duration means what? That the duration will be higher. And if the coupon is lower, then the duration will be higher. And if earlier cash flows are there, like if you're having more cash flows, then the duration will be lowered, right? That's the part. And there is a core relationship into it. We can be signifying it like saying delta P is equivalent to minus D into delta R. Now, what does this indicate? Delta P is basically related to change in price. D is the duration, and delta R is change in the interest rate. So this is a core relationship. So if there is more change in price or economic value will be there if there is more change in interest rate, right? Is that clear to you? And we can be having the weight gap calculation, or we can be having the stepwise approach. Like we can be having two approaches when we have to calculate the duration. It could be a stepwise approach. And which one is stepwise approach? Like first of all, we have to divide the balance sheet into different time bands. We'll be assigning the average duration to each band. We'll be multiplying the duration by the interest rate change, right? So this is the stepwise approach. So under stepwise approach, what we'll be doing? Let me just write over here. Let me just find some space first of all. Right. So in stepwise approach, first of all, we'll be dividing the balance sheet based upon the time bands, like the 0 to 1 month, 1 to 2 months, 2 to 4, 5 months, 6 months, etc. These will be the different time bands. And for these time bands, we are to assign the average duration. We'll be assigning the average duration to these time bands. And after that, we have to multiply the duration with the interest rate change. right? And further, based upon this, we have to apply the weight, this particular weight, because we have already multiplied the duration with the interest rate change, and now we'll be applying these weights to the assets and liabilities, to assets as well as to liabilities. These weights will be applied, and further, then we'll be looking at the aggregate weight gaps, that on the total assets will be having the total duration, on liabilities will be having the total duration, and then we'll be looking into the weight gap. So this is a stepwise approach which is to be followed, right? So what is weight gap? If we are particularly looking at the weight gap, what is the process? What is the formula? The weight gap formula is basically the gap that we just calculated, like we assigned the particular durations with the interest rate change, and further we are having the duration way with us, and that is to be multiplied. Duration weight and multiply with the interest rate changes, right? So that is to be done. So that is to be done. Okay. And what will be the outcome of the duration analysis? Like the duration gap, D gap, we can say this D gap will either be positive or it could be negative. So if the duration gap is positive, then the economic value falls. The economic value will fall, that will decrease when the rate increases. So if interest rate increases, the economic value will fall. And on the other hand, if we are having the negative duration gap, in that case, economic value will increase if the interest rate increases. Clear with it? And if we do consider the gap analysis with the duration analysis, in that scenario, the gap analysis was upon the net interest income, but the duration analysis is focused upon the economic value analysis. Gap analysis was for the short duration, the duration analysis for the long duration. And gap analysis was quite simple. Duration analysis is complex one, right? So that's the case. I hope that you are clear with these points so far. So that will be all related to this video. I hope that you must have understood the concepts. And if you want the complete PDF, just simply do WhatsApp CAIIB and WhatsApp it to the number 83609 I'll be sharing all the details with you. And still, agar you want to join the crash course of the CIIB, the complete crash course is available. Simply just WhatsApp me and I'll be sharing the details related to it also. Thank you so much and see you again in the next video.